Let's bring in CNBC contributor Trivariate's Adam Parker. It's good to have you with us. The market seems to be taking this exactly how Megan ended there, that this was a symbolic response and meant as much to move to an off-ramp if possible, and the market's reacting as such. Is that how you would view it?
I mean, clearly the market's a forward discounting mechanism, and it's saying today that it's less worried about it than it was yesterday. I don't have any individual personal intelligence on that, but we spent the weekend trying to think about our earnings estimates and actually raised them because my initial reaction in April was to lower my estimates a lot and kind of say the 26 numbers were 27 and this tariff stuff's going to be bad. And I took a look, pretty hard over the last couple of days and said, well, maybe I was too harsh as my initial reaction. So I don't know if I'm playing checkers, everyone else is playing chess.
I don't know. Are you? Maybe you were attempting to play chess, but you overthought it. I mean, a lot of what people had feared was going to happen hasn't happened. And maybe you were among that cohort that thought things were going to deteriorate a little bit.
Well, I think we didn't have that, taco phrase, about tariffs, right? That Trump chickens out on what he says on the tariff front. And I sort of thought, wow, this is going to sort of create a bit of a pull forward in demand. It's going to create some volatility in the P&Ls of companies. But taking a step back, we saw when we had some inflation last cycle, although there was a much stronger GDP then, that the big 50 companies were kind of immune. And the big 50 companies are half the gross profits of the market. The financials are in good shape. And so you're left with looking at the rest of the companies and what could happen to their margins. They are down the last couple of months, but the dollar isn't going to hurt for the multinational ones. Look at oil today and other input costs. If you look at like a broad commodity index, I don't think that hurts that much. So I think I was just a little too harsh about what it would do. And so far, it's held up. I think the institutional investors I talk to think there's a risk we hit a soft pocket August through October. Inventories are high in a lot of economically sensitive places. But I still think we're dreaming about AI stuff next year, and that's why it's hard to get too negative.
But you don't have to be a geopolitical expert to sort of assess what's happened already in the Middle East, thinking about and gaming out what potentially could happen from here. Obviously, escalation, bad for stocks. De-escalation, good for stocks. Closing the Strait of Hormuz, bad for stocks. Not closing it and having this be the degree of the retaliation, it's good for stocks. That's how the market seems to be reacting.
I guess I just would say, and this, it's just with a 1 hour or a 1 day lens. I still don't know everything from do we really know what damage we did in Iran to how long would they close the strait? I mean, there's so many unknowns that when I think about the earnings impact for the biggest 500 U.S. equities, I think the correct response is not to overthink it, that they're probably not impaired that much.
Okay, so are you bullish the market now from changing your view on earnings? Because why else? Why would you be bearish?
I think the challenge was the market rallied really fast, I thought, from the lows in April. I thought it was a little ahead of itself. And now taking a step back, I think the numbers are too high this year, but not crazy too high. And I think if I still can believe in this innocent until proven guilty way that all the AI investments done in 23 and 24 have a likelihood of hitting the P&Ls of companies next year, absent this being something worse than we see right now, it's hard to get too negative when I still can dream margins are going up next year.
Well, that's the whole thing. You're already looking for next year. You're already looking towards next year.
Right, and the reason is because, remember, our minds get messed up, but nobody knew about AI until really early in 2023. It's only been 2 years. I went back, you look at the 4 biggest firms, Morgan Stanley, Goldman Sachs, JP Morgan, UBS, take their November 2022 year-end outlooks for 23, economics and U.S. strategy, the words AI, the letters AI were used 0 times in those 8 documents. It's 2.5 years ago, 0 experts were talking about AI. We know a lot of the AI investments were 2 to 3 years initially before we see the benefits.
That's not a knock on the experts, by the way. Nobody knew.
It just was ramping. So now we're saying 2026 is around 3 years after those initial investments. So either it was all an unmitigated disaster that's the biggest hype ever, or
it doesn't appear to be that.
Right, and I don't think it's that, or we're going to start seeing the benefits next year. So I think it's hard to get too negative when I still can think there's going to be some better predictive analytics deployed into companies next year.
Not to mention.